Welcome to the Explainer. Today, we're stepping into the shoes of expert investment analysts and putting Honda Motor Company through an absolute valuation gauntlet. We are taking raw data straight from Honda's latest financial filings and running the ticker HMC through a series of unforgiving fundamental tests. We'll be looking through the legendary lenses of Warren Buffett, Peter Lynch, and Benjamin Graham before we crunch the hard numbers with discounted cash flow and dividend discount models.
So, here's our roadmap for today. We'll start with the Honda snapshot, move on to the Buffett, Lynch, and Graham lenses, tackle the DCF and alternative models, and wrap it all up with our synthesis and final verdict. Let's get right into it. Starting off with Section 1, the Honda snapshot, which is honestly a bit of a financial puzzle.
Just look at this number. Negative $2.8 billion. That is Honda's most recently reported annual net income. When you see a massive legacy automaker printing a multi-billion-dollar loss, right away, alarm bells start ringing, don't they? But as you'll see, in the investing world, the headline statutory number rarely tells the whole story.
Because despite that negative earnings per share of $2.10, the revenue sits at a staggering $143.86 billion. That creates a really unusual baseline for our models. The stock is trading at $30.68, and yet management is still committing to an annual dividend of 70 yen per share. So think about that. We have a company generating colossal revenue, paying a consistent dividend, but posting a severe statutory loss. How does that happen? Well, the core driver of this loss is actually a massive strategic pivot. Honda is basically eating a monumental 1,577.8 billion yen in EV-related losses. They're actively choosing to take this huge write-down today so they can pivot hard back to hybrid vehicles. It's a massive reallocation of capital. So that $2.8 billion net loss, it's largely driven by a one-time strategy shift, not a collapse of their core business. We're going to need to keep that in mind as we run our models.
All right, let's move to Section 2, the Buffett lens, where we're seeking moats and cash.
You know Warren Buffett. He demands strict qualitative and quantitative trades before he even bothers looking at a stock price. He wants an economic moat, predictable earnings, strong returns on equity, manageable debt, and honest management. Only after checking all those boxes does he calculate intrinsic value to find that all-important margin of safety.
So to figure out approximate owner earnings, we combine key cash flow metrics to find the actual cash the business generates. Now, because Honda's net income is artificially depressed by that EV write-down, we look at depreciation of 410.2 billion yen against massive capital expenditures of 751.3 billion yen. This reveals a company spending heavily on its future. But to find the true owner earnings, we literally have to look right past that statutory loss. Evaluating Honda through the Buffett lens gives us kind of a split decision. They definitely have a clear economic moat in motorcycles and internal combustion engines, and they easily pass the manageable debt test with 33.5 trillion yen in total assets, perfectly balancing its liabilities. But actually, they failed the strict consistent earnings and ROE test on paper. That one-time EV write-down completely breaks the historical consistency Buffett loves. So Buffett would likely require a huge margin of safety here, probably waiting on the sidelines until that adjusted return on equity normalizes. Next up is Section 3, the Lynch lens, focusing on categorizing growth. Peter Lynch always looks at the story behind the numbers. He categorizes companies into specific buckets, think stalwarts, fast growers, or turnarounds. He's always hunting for favorable growth ratios, specifically the PEG ratio, alongside a rock-solid balance sheet. And this is where we have to look past the statutory noise. If we exclude those EV-related losses, Honda's adjusted operating margin is actually incredibly resilient, sitting around 5.6% for the fiscal year. Lynch always favored a company where the core engine is highly profitable, but maybe temporarily obscured by a setback that the market is completely mispricing. Okay, time for an analyst assumption break. Because basic EPS is currently negative, we mathematically cannot calculate a standard PEG ratio. That places Honda squarely in Lynch's turnaround category. The balance sheet story is incredibly strong, though. Management expects to generate over 7 trillion yen in operating cash flow over the next 3 years. But for Lynch, this isn't a screaming buy until that turnaround actually shows up in the EPS column. So the verdict here is a solid hold.
Let's turn to Section 4, the Graham lens, where we dive into defensive deep value.
Benjamin Graham is famously ruthless. He focuses heavily on book value, strict defensive investor checklists, and demands a severe margin of safety. He uses a very specific formula to calculate intrinsic value, relying entirely on trailing earnings per share and book value per share.
Running the numbers, Honda passes effortlessly on adequate size with over $143 billion in revenue, and it definitely passes the continuous dividend test. But Graham demands a full decade of positive earnings. That current net loss? It automatically fails the earnings stability test. Plus, a negative EPS means a moderate PE ratio is just impossible to calculate.
And the crucial point here requires another assumption break. If you try to plug a negative $2.10 EPS into Graham's square root formula, you literally get an imaginary number. The math just completely breaks. To find any sort of value floor, an analyst has to assume a normalized forward EPS that excludes the EV write-down. But for a strict Graham defensive investor relying purely on historical data, yeah, it's a hard pass until positive earnings return.
All right, let's crunch some numbers in Section 5, DCF and alternative models.
To build our base case DCF, we're looking directly at Honda's own guidance. They expect to generate over 7 trillion yen in operating cash flow over the next 3 years, and that's excluding the EV losses. We have to introduce another analyst assumption break here to fill in a few blanks. We're going to assume a weighted average cost of capital, or WACC, of 8% and a pretty conservative perpetual terminal growth rate of 2%.
When we factor in slight adjustments to our discount or growth assumptions in a sensitivity table, the picture remains really clear. At an 8% WACC and 2% growth, Honda's massive projected cash flows suggest its intrinsic value is actually comfortably above its current $30.68 share price. If that 7 trillion yen in operating cash flow actually materializes, the DCF model signals the stock is undervalued today, assuming, of course, they execute on this massive hybrid reallocation. Applying a dividend discount model, or DDM, gives us a second quantitative target. This model is completely anchored by management's strict internal policy, a continuous 70 yen payout and a target 3.0% dividend on equity. Because this dividend is highly predictable, supported by the massive cash flows of the motorcycle and hybrid businesses, the DDM also points toward a really healthy fair value. For income-focused investors, this totally justifies the current entry price.
Finally, we arrive at Section 6, Synthesis and Final Verdict.
Blending all these insights together, Honda is a genuinely fascinating mixed bag. It completely fails the strict historical guru checklists of Buffett and Graham, mainly because that massive one-time EV write-down just destroys current earnings on paper. But viewed through Peter Lynch's turnaround lens and our forward-looking DCF and dividend models, the stock really shines. So what's the final verdict? We're looking at a hold or slowly accumulate. Yes, the strategic pivot away from pure EVs back to hybrids is messy on the income statement, but it is entirely funded by a core business that generates staggering amounts of cash.
So I want to leave you with this final thought to consider before you make your next portfolio move. Does absorbing a massive short-term EV loss today make Honda the ultimate long-term value play tomorrow? If management is right, ripping the Band-Aid off to the tune of 1,577 billion yen right now secures their dominance in the hybrid market for the next decade. Thank you so much for joining us for this explainer on the Honda Valuation Gauntlet. Keep analyzing, keep questioning, and we'll see you next time.